All right, welcome. Today, we're going to pull back the curtain on some of the most powerful data in the market. Our goal is to show you how to read volume, liquidity, and liquidations using some incredible free tools so you can, trade smarter, not harder. Let's take a look at what we'll be covering.
So what's on the menu today? We've broken it down into 5 key parts. We're going to kick things off with volume. Think of it as the market's pulse. Then we'll build on that with liquidity. Check out a huge innovation in DeFi, and then follow the money with liquidations. And finally, we'll tie it all together into a smart, actionable framework.
Okay, so first up, volume. This is really the foundation for everything else we're going to talk about. It tells us the story of conviction, how much real activity and strength is actually behind any price move you see on a chart.
So what is volume exactly? Well, put simply, it's just the total amount of an asset being bought and sold over a certain time. And why does that matter? Because it's probably the single best tool you have for telling the difference between a real, sustainable trend and, a total fake-out that's about to collapse.
And this is where it gets really interesting, right? Volume basically tells 2 key stories. So, if you see price going up and volume is climbing right along with it, that's your confirmation. That's a strong, healthy trend. But, and this is a big but, if the price is creeping up while volume is actually falling off, that's a huge red flag. It's screaming that the momentum is fizzling out.
And hey, the best part, you don't need some fancy, expensive subscription for this stuff. You've got amazing free platforms you can use right now. You've got tools like CoinGecko for a great global overview, or you can just pop a volume indicator right onto your charts in TradingView. It's all right there.
All right, so now that we've got volume down, let's build on that with our next big idea, liquidity. You can think of it like this. If volume is the engine's power, then liquidity is the oil that keeps everything running without friction.
So what is liquidity, really? In super simple terms, it all comes down to one question. How deep is the market? If you want to place a big trade, can you actually get your order filled at a stable price? Or is your trade going to send the price flying? A liquid market lets you do that. An illiquid one, well, that can get very expensive very fast.
And this slide just lays it out perfectly. High liquidity, that's what you want. It's a trader's best friend. You get tight spreads, you don't lose a bunch of money to slippage, and the price action is just smoother. Low liquidity, on the other hand, well, that's a recipe for disaster. We're talking wide spreads, painful slippage, and these just violent, unpredictable price swings.
Okay, so now things get really cool, because this whole concept of liquidity got a massive upgrade, a total revolution really, in the world of DeFi, that's decentralized finance. A single innovation completely changed the game.
You see, the original way DeFi protocols handled liquidity, well, it was kind of a mess, super inefficient. Imagine you're a liquidity provider. You had to spread your money out across every single possible price from basically 0 to infinity. And guess what? Most of that cash just sat there, completely dead, never getting used.
And that's what led to this game-changing idea called concentrated liquidity, which Uniswap v3 really pioneered. So instead of that spread it everywhere model, providers can now say, hey, I think the price is going to trade between X and Y, and they put all their capital right there, right where the action is. So much more efficient.
But of course, there's always a trade-off, right? This isn't free money. On one hand, you get this amazing capital efficiency and way deeper markets for traders. But on the other hand, it's not a set it and forget it kind of deal anymore. You have to actively manage your position, because if the price moves outside that little range you set, boom, you stop earning fees.
Okay, this next section is my favorite because it's probably the most predictive tool we're going to talk about, liquidations. This is all about following the money, or maybe more accurately, following the pain. We're looking for where the over-leveraged traders are about to get wiped out, because that's often a huge clue about where price is going next. So the big question, right? Where is price likely to go next? Well, one of the most powerful ways to get a hint is to look at something called a liquidation heat map. It shows us exactly where huge clusters of leveraged trades are set to be force closed. So what are these things? Well, liquidation heat maps are pretty much what they sound like. They're these visual charts that highlight the exact price levels where a ton of leveraged longs or shorts are going to get liquidated, forced to close by the exchange. These are the financial landmines of the market.
And why should you care? Why is this so important? Because these zones, these pockets of future liquidations, they act like massive magnets for price. You'll often see the market get sucked right towards these levels, especially during big moves, to trigger those stops and absorb all that liquidity.
And you know what's great? Again, this isn't some secret data for institutions. It's totally free and accessible to you. Tools like Coinglass, for example, are fantastic. They give you these incredible real-time heat maps so you can see exactly where these liquidation magnets are building up. All right. We've gone through volume, we've talked about liquidity, and we've dived into liquidations. Now let's do the most important part. Let's put it all together. We're going to synthesize all this into a simple, actionable framework that you can actually start using.
Because look, the real magic here isn't about using just one of these tools in a vacuum. The real edge comes from layering them on top of each other. You start to build this complete, multidimensional view of the market, from conviction to structure to the most likely targets.
And this is it. It's a simple, 4-step framework. Step 1, check the volume. Is there real conviction behind this move, or is it just noise? Step 2, identify liquidity. Where are the deep pools of orders on the chart? Step 3, spot the liquidations. Where are the heat maps telling you the price might be pulled towards? And then, step 4, and this is absolutely crucial, use confirmation. You combine all this data with your own solid analysis. You don't just trade based on a heat map.
And really, that's what it all boils down to. The goal is to help you stop chasing price, stop reacting emotionally to every little wick on the chart. Instead, you start to anticipate. You wait for those perfect moments where everything aligns, where the volume, the liquidity, and the liquidation targets all point to the same story. That's where the smart trades are found.